Screens froze, quotes vanished, dealers stopped answering phones. Within minutes, the Swiss franc had moved more than 30%. Several trading desks were insolvent before lunch. It was January 15, 2015, and a policy that had defined Europe's quietest currency suddenly no longer existed. The announcement itself was brief. 3 paragraphs released by the Swiss National Bank at 9:30 a.m. Zurich time. No press conference, no countdown, no warning. One sentence did the work. The minimum exchange rate of 1.2 francs per euro would be discontinued with immediate effect. By the time the words were fully read, prices were already obsolete. For more than 3 years, the franc had not behaved like a normal currency. It had been constrained, managed, and held in place by a promise. That promise was widely understood, deeply integrated, and rarely questioned. When it disappeared, the reaction was not confusion about mechanics. It was confusion about scale. In the early hours of that Thursday, trading floors in London and Frankfurt opened as they always did. Screens refreshed. Overnight orders rolled into the European session. The euro-franc pair printed close to 1.2 as it had nearly every day since 2011. Spreads were thin. Liquidity appeared normal. Nothing suggested instability. The constraint itself had been introduced during a different crisis. In September 2011, the Eurozone was under acute stress. Sovereign bond yields in southern Europe were climbing. Capital was moving north. Switzerland, with its political stability and strong external balance, had become a destination rather than a participant. Money arrived faster than the economy could absorb. The franc appreciated sharply. Exporters complained. Tourism weakened. More importantly, the exchange rate began to threaten deflation. Import prices fell. Domestic demand softened. Monetary policy reached its limits. The Swiss National Bank responded with an unusual commitment. It declared that it would not allow the franc to rise beyond 1.2 per euro. The bank would buy foreign currency in unlimited quantities if necessary. The statement was clear, repeated, and operationalized. Over time, it became structural. Markets adjusted their behavior. Corporations priced contracts with the floor in mind. Asset managers treated the 1.2 level as a hard boundary. Retail brokers offered leverage assuming stability. The exchange rate chart flattened. Volatility compressed. Balance sheets adjusted as well. To defend the floor, the central bank accumulated foreign assets. By 2014, its balance sheet exceeded 80% of Swiss GDP. Reserves were held in euros, dollars, and equities. The institution became one of the largest investors in global markets, quietly and without mandate expansion. At the time, none of this appeared urgent. The peg was working. Inflation remained low but stable. Growth continued. Political support was intact. The alternative, allowing the franc to strengthen freely, remained unattractive. The risk was visible only in fragments. Each euro crisis headline triggered renewed inflows. Each defense of the floor required additional purchases. The scale grew, but gradually. The mechanism held. What reinforced the stability was repetition. Every reaffirmation of the peg reduced perceived risk. Each successful intervention made the next one seem less consequential. The promise was not tested because it was believed. By late 2014, the environment began to change. The European Central Bank prepared a large-scale asset purchase program. Quantitative easing, long discussed, was approaching implementation. The euro was expected to weaken. For Switzerland, that shift mattered mechanically. A weaker euro meant more pressure on the floor, more inflows, larger interventions, balance sheet expansion without a clear endpoint. The cost was not immediate, but it was cumulative. The Swiss National Bank adjusted at the margins. In December 2014, it introduced negative interest rates on sight deposits. The move was designed to discourage inflows without altering the exchange rate commitment. It was framed as complementary, not substitutive. Markets took note, but behavior did not change materially. The floor remained. The assumption held. Internally, the decision space narrowed. Maintaining the peg implied continued expansion of reserves in a context of accelerating euro weakness. Ending it implied an immediate, potentially violent adjustment. There was no neutral option. What alternatives existed were structurally constrained. Raising the floor would invite speculation. Lowering it would signal weakness. Capital controls were politically untenable. Coordination with the ECB was limited. The system was asymmetrical. By early January 2015, timing became the variable. The ECB's asset purchase announcement was expected within days. Acting before it would concentrate volatility. Acting after it would require defending the peg against a larger wave. The decision was made quietly. Operational details were finalized. Liquidity arrangements were reviewed. Communications were drafted and compressed. The objective was not surprise for its own sake, but containment. At 9:30 a.m., the statement was released. At 9:31, prices stopped reflecting reality. The euro-franc pair printed 0.97, then 0.9, then briefly below 0.85. Some platforms showed trades near 0.8, others showed nothing at all. Liquidity evaporated. Market makers withdrew. Stop-loss orders triggered into absence. On several retail trading platforms, prices were frozen while risk systems recalculated. Margin calls exceeded account balances. By noon, multiple foreign exchange brokers announced severe losses. One, based in New Zealand, entered insolvency within days. Institutional desks fared unevenly. Those with unhedged exposure absorbed losses quickly. Those relying on options discovered that volatility assumptions no longer applied. The move exceeded stress scenarios. The Swiss equity market reacted immediately. Exporters fell sharply. The benchmark index dropped nearly 10% intraday. Shares of watchmakers, pharmaceutical firms, and machinery producers repriced on new currency expectations. Outside Switzerland, the effects propagated through risk systems rather than headlines. Banks reassessed counterparty exposures. Clearinghouses reviewed margin requirements. Some hedge funds reported significant drawdowns. Others closed. The Swiss National Bank did not intervene to reverse the move. It did not reintroduce the floor. It allowed the exchange rate to find its level, which it did slowly and unevenly. In the following days, the franc settled around parity with the euro, fluctuating within a wide range. Volatility remained elevated. Trade volumes normalized only gradually. The shock did not repeat, but it did not disappear. Official communication remained restrained. The central bank emphasized sustainability. The peg, it said, was no longer justified. Conditions had changed. The decision had been necessary. Public reaction within Switzerland was mixed but controlled. Consumers benefited from cheaper imports. Travelers found foreign prices lower. Export-oriented firms announced margin pressure. Wage negotiations were reopened. Politically, the episode did not produce immediate upheaval. There were questions in Parliament. There were calls for explanation. But the institutional framework remained intact. What shifted more decisively was the narrative outside the country. The franc had been treated as a low-volatility asset. That classification was removed. Risk models were adjusted. Assumptions were rewritten. In the months that followed, attention moved elsewhere. The Eurozone focused on Greece. Global markets adjusted to oil prices. The Swiss event receded into case studies and footnotes. Later accounts often simplified the episode. Some framed it as a failure of communication, others as a warning about central bank credibility. The scale of losses was emphasized. The suddenness was criticized. Less attention was given to the structure that preceded it. The peg had not failed in operation. It had reached its boundary. The constraint was not broken by error, but by accumulation. The decision itself was not irrational in isolation. Ending the peg earlier would have produced a similar adjustment under less favorable conditions. Ending it later would have required larger interventions. The choice was between paths, not outcomes. What remained misunderstood was the nature of the promise. It was not a guarantee in perpetuity. It was a policy tool contingent on conditions that were always external. Its stability depended on forces beyond domestic control. By 2016, the Swiss economy had adjusted. Growth resumed. Inflation remained subdued but manageable. The central bank continued to hold a large foreign asset portfolio. Negative rates persisted. The franc continued to trade with episodes of strength during global stress. It remained a destination in uncertainty, though no longer bounded by a visible line. The brokers that failed were liquidated or absorbed. Losses were allocated through legal processes. Retail traders learned, often expensively, about leverage and liquidity. The Swiss National Bank survived without structural reform. Its mandate remained unchanged. Its balance sheet remained large. Its discretion remained intact. The peg was not reinstated. The chapter closed. What lingered was not the event itself, but the category it represented. A system designed to appear static had revealed how much motion it contained. Stability had been engineered, not inherent. The adjustment happened in minutes. The conditions that made it inevitable took years to build. The market experienced only the release, not the accumulation. The franc found a new role, and the policy ended. What remained unresolved was not accountability, but recognition. How often stability rests on constraints that function only while they are believed, and how quietly those constraints can reach their limit.